So this video is particularly important because neither my foundational videos nor the Smart Book has the depth of information that I want you to know for the financial statements. We're going to cover at the very end of the semester the balance sheet and the income statement in depth. We're going to go much deeper into a lot of different accounts that you're not familiar with yet, but will be more familiar with at the end of the semester. Now, for now, I just do want to cover the foundationals, the fundamentals of these guys. And this is the order of preparation for our statements, the income statement, statement of stockholders' equity, to the balance sheet, to the statement of cash flows. The statement of stockholders' equity, remember, is basically you can decompose stockholders' equity into two major parts right now for our level of understanding and where we're at in the accounting curriculum. Basically, there are changes in stock accounts. So this is your, change in common stock, your change in APIC from common stock, preferred stock, right? All of those would go here. Treasury stock also would affect this. Now, the rest of the equity section that we know of so far is the retained earnings. Okay. So those are the two pieces that might help you understand, right? Remember, I'm only going to delve into an intermediate one a lot about statement of retained earnings. The entirety of the statement of stockholders' equity is an intermediate two topic, as is the statement of cash flows. But we do want to cover some of the just found fundamental pieces of those in this course as well. And why do we have to prepare it that way? I mean, knowing one, two, three, four, this is first, this is second, doesn't mean anything unless you understand the why of it. And the why will help you actually do well on a test. Yeah, I'm not going to ask you the order of preparation for the financial statements. That's basic. What I would ask is something like, how does the income statement fit into the statement of retained earnings? How does the statement of retained earnings affect the balance sheet? Something like that. All right, so we need the income statement because that gives us net income. And then once I get net income, I can funnel that into the statement of retained earnings. Remember that we have a beginning balance in retained earnings. That is whatever's in our T account at the beginning of our accounting period. We add any net income that we recorded during the accounting period. We subtract dividends we paid during that accounting period, and that gets us to an end balance, an end RE balance. Now, to actually record that balance in our T accounts, we have to go all the way through closing entries, but we can do some simple arithmetic to get that end balance prior to that. So this end balance, ending RE balance, then is carried over into the balance sheet. That's what we want to put as our closing balance for retained earnings on the balance sheet, whatever this was after we added net income and subtracted dividends from our beginning amount. Same is true for these changes in stock accounts. The ending equity balance here, equity balances of the accounts, because remember, like I said, there's stock accounts, there's APIC accounts, preferred and common, but we show the changes of the stock accounts over time. That too gets recorded onto the balance sheet. And finally, why is the statement of cash flows last? Because, I mean, we could do a statement of cash flows first if we did it in what we call the direct method, where we show every disbursement of cash, every payment of cash, every receipt of cash from the company. Yeah, we could record that first, but most companies use what we call the indirect method. And that's because they believe that showing all of their direct cash flows in operations would represent a proprietary cost that they don't want companies to know, other companies, competitors to know how they handle their cash account and what they use in order to kind of run their company. So, in order to do the indirect method, we have to have the income statement complete and we have to have a complete balance sheet. Because how we determine cash flows then is a reconciliation. We start with net income, use the balance sheet and the income statement accounts to strip out accrual income so that the only thing that's left in net income is just the cash flow. So that's the big idea, the big picture. Now, how is let's look at it a little bit differently. Like, how are all these things related? Now, balance sheets, remember, are at a specific date. So I have a balance sheet at 12 of 31 X1. Um, at that specific date, I would have, of course, cash, non-cash assets. I'm just doing very broad stroke generalizations. I'm not going to record every single item that could be an asset. We have some liabilities and we have equity, right? All of these balance sheet balances are the opening balances of our T account at 12/31 X1. All right, so that's the state of affairs at the end of the prior period. And that's the state of affairs as we go into the next year. Now, the financial statements other than the balance sheet all show me what happened during the period. So, for example, cash is going to change. We are going to record and list how cash changed, why it changed. Was it operating activities? Was it financing activities? Was it investing activities? And that's the statement of cash flows. The statement of cash flows reconciles my beginning balance to an ending balance, which gives me my end of period data for all of the accounts that on the left-hand side were at the beginning of the year. So of course we'll have the same things, cash, non-cash assets. So all our other current assets, PP&E, intangibles, etc., all our liabilities, and all our equity. This is the balance sheet at the end of an accounting period. And here, in this example, right, I've defined the accounting period as a year, right? It's the year 20x2, where we started at the end of the prior year and end at the end of the current year. So the statement of cash flows determines or tells the story of what happened to cash over time. The statement of owner's equity tells the story of what happened during the year to all of my equity accounts. Remember, this would include both my changes in stock accounts and my change in retained earnings, right? Where the stock accounts began, all of the things that happened to them, and then where they end up. Now, the final financial statement, ironically, the one that we begin with, is the income statement. And that tells me about all of the revenues and the expenses that the company recognized during the period. We take those revenues, we subtract off expenses, and we get our net income for the accounting period. Remember, this net income then becomes an essential piece of the change in retained earnings. Remember this, right? Beginning retained earnings, which would be under equity here, plus net income, what we derive here, minus dividends, not shown, but would just affect this change, gives me ending balance retained earnings. Now, remember that the balance sheet is at a date, a specific date and time, whereas all of these would be for the year 20x2. So they would not have a particular date because these statements are what we would call flows. They show the flow of items over a particular period, right? How things changed from one stock once we like we the stock, we can measure an account and show that it's at this level at this stock, right? That not like the stock we trade, but the the amount we have at this date. Then everything that happened during the year, our flows to the ending stock of each of these accounts, right? We take stock at the beginning of the year, we take stock at the end of the year. These are my bookends, and the other three financial statements are everything in between those. Now, there is a little bit more of an intricate relationship between the balance sheet and the income statement. And the balance sheet and the income statement are very closely related. So again, just thinking of a balance sheet, and that balance sheet has, of course, assets and liabilities, and it has equity. I'll break it out into stock accounts, common, preferred, APIC, and retained earnings. And then we have an income statement. And again, I'm just going to be very simplistic and general. Basically, we have revenues, gains, expenses, and losses, right? Revenues and gains increase net income, expenses and losses reduce net income. And that gives me my summary measure for the income statement. All right, so now the question becomes, how does the income statement tie into the balance sheet? Well, from the prior visuals that we have, definitely income ties into the statement of retained earnings, which is an equity account. So that's our first cut. That as we close net income, it affects retained earnings. But that's not the only effect from the income statement to the balance sheet. Remember, and it affects retained earnings. It is a positive effect if we have income, and it is a negative effect if we have a loss, right? So this number here. If we have income, it's positive. If it's a loss, it's negative. And if losses reduce retained earnings, income increases retained earnings. Remember now for the second effects, we got to go back to the definition of revenues, expenses, gains, and losses. Revenues and gains are defined as increases to assets or reductions to liabilities from company operations. Expenses and losses are the exact opposite. They are reductions to assets or increases to liabilities from company operations. Got to have those definitions down. That is part of the importance of the first chapter. And it shows me then that anytime I recognize a revenue or a gain, there will either be a positive increase to an asset or a reduction to a liability. And that's true for both revenues and gains. And then if I recognize an expense or a loss, I will have a reduction to an asset account or an increase to a liability account. And so the income statement, as I mentioned, is very much related to what's going on in the balance sheet. Notice that I only draw effects over to the income statement because a change in an asset account doesn't always have to be an income issue, right? We can, for example, buy equipment with cash. That's a positive change in one asset and a negative change in another asset, right? Liabilities, same idea. Liabilities can go up or down without having any gains or losses recognized. For example, we might have used cash to settle an obligation with a supplier. We would debit accounts payable, credit cash. That means that assets are going down and liabilities are going down, but there is no gain or loss. But if we recognize a gain or revenue, the debit has to always be either an asset or liability. If we recognize an expense or a loss, that's a debit. The credit always has to be an asset or a liability. So this is what we call the articulation between the income statement and the balance sheet. Very important to understand as you look at financial statements and appreciate how they are related to one another. So the rest of this piece goes through each of the financial statements one at a time, and I will include that in a separate video.